Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today I want to cover a topic that is a continuation of what we spoke about last week, which is how to grow a small options account. We talked about the strategies in terms of option strategies that you could deploy to help you grow a trading account. And the reason that we're looking at strategies like vertical spreads with the credit spread is that it's very easy to define how much potential risk you have and how much potential reward you have. It's easy to plan around that. So today it's going to be part two, where we take that to the second step, where we talk about how do you take a strategy like that and gain more consistency in your options trading and gain consistency in the profits and losses that you have in your portfolio. This is arguably, in my opinion, the most important lesson that investors need to learn. Whether you're a stock trader or an options trader, whether you like to sell credit spreads or buy calls or trade iron condors, it doesn't matter. The rules that we're going to talk about here today, the shift in psychology that I'm hoping to be able to instill in today's lesson, is going to be applicable and is going to be I think probably the most valuable tool in your toolbox in order to succeed in trading. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So during today's session, what we're going to do is, actually, before we jump in, I just want to do a bit of housekeeping in terms of upcoming events. So we're covering gaining consistency in trading today. Tomorrow morning, we're doing our next thematic investment series. This is where we're going to be talking about the future of work. We're going to talk about cloud computing. We're going to talk about the different companies that are going to benefit from our shift in working from home, the different types of cloud companies. We're going to do a deeper dive into many of the companies that power our ability to work from home. Next Thursday, I'm doing a special event with Michael Ko, the co-host of Options Action. We're going to be talking about trading oil futures. A lot of interest in crude oil, so we want to talk a little bit about that. So we'll talk about trading small oil futures with Michael Ko, and then the following Thursday, I'm doing a session that I had to cancel in May. I'm doing it in July here. In early June, I canceled it. We're going to do it again in July, which is understanding liquidity and how market making works. Because I get this question almost every single week. An investor asking me why I trade something with low open interest and volume. And what it speaks to is a lack of understanding as to how liquidity works and how market making works. A lot of investors get the sense that if something has low volume or low liquidity, that you're going to get stuck in the contract. You're not going to be able to get in and out of that contract. That is about as far away from the truth as possible. So I want to demystify that and actually spend some time making sure you guys understand how the other side of a trade works to help you better understand how you can find liquidity in the markets for your trading. And then when we come back, we're going to talk about a rapid fire session where we do a technical and fundamental analysis on the broader markets. Gary, the Tuesday morning market outlooks are always there. This is in regards to kind of more special events or more educational events. We always do the Tuesday morning market outlook sessions. But the primary question, as far as what we're going to cover here today, first and foremost, what I want to help establish is an understanding of the difference between strategy and psychology, because a lot of investors get mixed up between the two with respect to what is driving the success or what is driving the lack of success in your trading. Is it your strategy or is it your psychology? So we want to really make sure that we understand the difference between the two. Then we're going to dive a little bit into this concept of trading psychology so that you understand whether or not, how to go about thinking it from the right way. There is, in my opinion, a right way and a wrong way to think about the winners and losers in your portfolio. And the way you approach it is going to have a significant impact on the long-term success of trading it's an area, I think, of trading that many educators and many traders don't spend enough time thinking, because we spend all our time thinking about strategy. We think all of our time about technical analysis, fundamental analysis. We consume ourselves with the news that's out there, but we don't spend enough time thinking about how much psychology affects our ability to handle wins and losses, because at the end of the day, we are human beings, we are emotional beings, and it does affect how we trade. And ultimately, it has a huge effect on our bottom line. So that's why I want to spend quite a bit of time here discussing that. Then once we have a better understanding as to how psychology affects our trading, I want to talk about the golden rule of trading, how we can trick our brains, if you will, to some degree, to allow to shift our way of thinking and move it in our favor by applying this golden rule of trading. And some of you that have been with me for a while, you've learned this golden rule of trading. Many of you tell me that you already applied this golden rule of trading. I'm glad that you do. But for those of you that are new, this is going to change the way you think about your portfolio and the way you think about risk. And even for those of you that have seen this session here before, I've changed the format a little bit to give you a different perspective, hopefully to help you understand the shift between what I believe are successful traders and how they stand apart from basically everyone else. And in order to understand that, we have to talk a little bit about the difference between linear versus exponential functions, and talk a little bit about how consecutive losses compound losses, and the difference between consecutive losses versus a huge loss with respect to blowing up your portfolio, because we have all seen portfolio blowups. It's not pretty, and the question is, how do you prevent it? And then we'll open this up for Q&A here at the very end. But like I said, the primary question that I want to help investors answer from today's session is, what can I do to gain better consistency in my profits and losses in my trading? So before we get started here, let's do a quick, please bring up your chat window at the bottom of your screen. I'm curious, how many of you find it difficult to gain consistency in your trading? Please type yes if you find it difficult to gain consistency in your trading, and type no if you feel that you've already got this down in terms of figuring out a more consistent approach to trading. Okay, so overwhelming number of yeses, quite a few no's as well. I'm hoping the ones that have answered no, you're answering no because you've already applied some of these things that we're talking about. And someone's saying average loss is bigger than average winners. So we're going to talk about all of those things and how that ultimately affects your bottom line. And again, psychology has a lot to do with it. So when you understand the psychology, that's when you have the opportunity to shift your views. And I want to start off by saying, what I'm going to teach you today is actually really, really simple. It's not complicated. It's so simple that sometimes the simplest things are the things that we have our hardest time wrapping our arms around and I would say embracing, if you will, because it is counter to our human nature. But it's actually quite simple what I'm going to teach you today. So hopefully you're going to be able to walk away from today learning something new, and hopefully with a plan as to how we can help you gain more consistency in your trading. So my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And what I'm going to teach you here is a result of 15 years of being a market strategist and working with thousands of retail and institutional clients over that period of time. And what I've learned and what I've seen and the strategies and accounts that I've watched rise in value, decline in value, and the patterns that I've seen that lead to inconsistent results versus the small number of accounts that do have very consistent trading in their accounts. What the difference between those two. And many times a lot of investors feel the difference is, the guys that are more consistent have a great strategy, and it's just a matter of finding that great strategy. And I cannot stress enough that the difference between a successful trader and everyone else has really nothing to do with strategy. Yes, those guys are better at using, many times have spent a lot of time honing their strategy, but it's not the strategy that differentiates successful traders from everyone else. It's psychology. It's how you manage winners and losers, how you think about winners and losers that define whether you're successful or not. So I'm going to bring up one chart here that I think define a lot of investors that say that they struggle with consistency with trading. So you have two charts. You have a bar chart showing you every single trade. Many times, many traders have these types of wins and losses. You have small winners, small losers, and you're kind of figuring out your way. You're trying to learn your strategy. You're trying to apply it. And then all of a sudden you have this huge loss in your portfolio. And there's a number of reasons that we have these huge losses in our portfolio, and then once we have this huge loss, we get very gun shy from trading again. And what we do is we try to build our way back up from that huge loss after huge losses. But it's usually this huge loss in our portfolio that blows a very large hole in our portfolio and really keeps us from continuing to progress forward in trading. If you can relate to this, please type 1 into the chat window. If you can relate to having a series of small wins, small losses, feeling like you're making progress, feeling like you're getting a little bit more comfortable with trading, and all of a sudden you have these huge losses in your portfolio. Okay, I see a lot of ones, okay? Now, because this is what I'm seeing with investors with these huge losses in their portfolio, this is how I know it has nothing to do with your strategy. Because if it was truly your strategy that was wrong, if it truly was the indicators that you're using, you're just using them in the wrong way, or you're following someone who's just really bad at trading, you wouldn't have huge losses in your portfolio. What you would have is a series of consecutive losses, and you would just have losses all the time. And this chart here would not look like this. The chart would look more like this, right? So that it's very important to understand the difference between these two charts, right? One is a bad strategy. That's a strategy that's just constantly losing you money in the long run. But when you have losses that look like this, it has nothing to do with your strategy. It has to do with how you're managing your risk and how you're managing your losses, okay? So and I'll just bring up an example of what I have seen over and over again from clients as to what leads to those big losses. And it's usually something along the lines of a trade where we get emotionally attached to a trade. And this is perfectly normal as human beings, because as human beings, we want to be right. We want to win, right? There's nothing wrong with that. But it's actually this desire to win, this pursuit of winning, that ultimately cause us, unfortunately, to have some of our largest losses in our portfolio. So, here's just an example here of a stock that gapped lower here and finally managed to fill this gap and break out higher. I think this is a pretty bullish pattern that many investors could get caught into, and we'll say, okay, it filled that gap, it broke out above it. I think it's going to now resume back up to that $8 level here or so. But instead, after you buy the stock, whether you buy a call option or if you buy the stock or you trade some credit spreads, the trade goes against you. What do? So this is really where this decision, the next decision you make, is what differentiates, in my opinion, successful traders from everyone else who struggles to gain consistency. Because I'm not saying you do it, I'm not saying you do it all the time, but all you have to do is just once. And that's what causes these blowups in your portfolio, which is, okay, this trade didn't work out. I don't want to lose. I don't want to be wrong. What can I do to fix this, right? And this is a common question that I get is, how do I repair a losing trade? And people will say, okay, I sold one credit spread, it didn't work out. Let me sell another one because I think that it might bounce back next month, right? Or next week, wherever it is. So you sell another credit spread, and guess what? Instead of bouncing back higher to that gap fill, it continues to move lower here. And what you do is you keep doing this over and over again. Many times, sometimes, I've seen this, unfortunately, where people lose their entire life savings chasing these types of trades. Now, that might be an extreme example, but this is something that a lot of investors do. And it has nothing to do with your strategy at this point. It all has to do with your emotional attachment to wanting to be right and wanting to win and not lose. And And I will say that I also find that some investors feel that as if they can correct losers back into winners, that's how they're going to be more profitable in the long run. And that couldn't be further from the truth, because it's trades like this where you find alternative reasons to now buy a stock or go long a stock that had nothing to do with your original reason to buy the stock to begin with, just to not lose. That's when you start making really bad decisions. So, and in this particular case, maybe you buy some here, you buy some more here, and the stock bounces higher here. And some of you are lucky enough to get out of a trade like this, maybe at flat or maybe at a small loss. And you think to yourself, oh, I've really, I'm really, this is a great way to repair a bad trade. But not everyone's lucky enough to get out. Sometimes you get a little greedy and you're saying, okay, I want to wait for it to get all the way back up here so I can make a profit, only to have the stock gap further lower. Now you've bought the stock once here, once here, once here, and the stock is down here again. At this point, this is really where I see people making really desperate trades, if you will, to try to get themselves back to break even. They start finding new reasons like, oh, there's a prior support here, let me buy some more, only for the stock to decline further. Then you start to see some negative divergence and you say, okay, that's definitely the bottom of the stock, let me buy some more, only to have the stock continue moving lower. And again, this is a bit of an extreme example, right? But I have seen this over and over and over again. And the thing is that you don't have to do it all the time. You just have to do it once. And that's what's going to drive you to have this type of loss in your portfolio. And this is the hard part about trading, is because you cannot make this mistake even once. If you make that mistake even once, game's over. And that's what we're trying to help you avoid here, is how do you shift your thinking and how do you shift your psychology to avoid this type of trading. And the reason that I go back to, making sure that you understand the difference between strategy and psychology comes down to the fact that a lot of investors, when they have this huge loss in their portfolio, what they don't do is look at, what did I do wrong from a risk management perspective? Most investors will say, what have I done wrong with my strategy? I'll have investors tell me, my strategy is terrible, I need to find a new strategy. I'll have investors tell me, I've had such a large loss in my portfolio, I'm going to stop options trading. And what that means is that you're not addressing the core of the problem. The problem is not the asset class you're trading. The core of the problem is not the strategy you're trading. It's not the way that you're trading. It has to do with how you decided to manage risk on a trade. So which is why we really have to spend some time looking at how do you manage risk. And the reason I know psychology is at the core of the problem is because this is the type of question that I receive on pretty much a daily basis. I get questions from investors saying, I have a losing trade. How do I repair that trade? This tells me that they're not worried. They're not thinking about risk management. They're thinking about, how do I not lose? Another question that I get very often is, how do I make my money back on a losing trade? Or sometimes I get emails saying that, hey, you've had 4 losing trades in a row on OptionsPlay. Your service sucks. I'm going to cancel it. And this tells me that, again, not thinking about strategy, not thinking about, worried about the long-term, worried about the wrong thing, if you will. And the question that I always ask investors is, are you asking the right question to begin with? And this is really where I have to introduce a concept called finite versus infinite games. And this is really at the core of how do you shift your psychology from trading in general to what I consider is the right mindset of trading. So James P. Carse is a NYU professor in the 80s that wrote a book called Finite versus Infinite Games. And James P. Carse is not a businessman. He's not a finance professional. He was actually a religious philosopher. And he wrote this book called Finite versus Infinite Games. And he theorized that there's 2 types of games. There are finite games, which are games that we all are familiar with, games that have a fixed set of rules, games that end at a certain point. And at the end, based on those rules, you are declared either a winner or a loser. And when you play a finite game, your only goal is to win. You do everything to win at all costs. An example of a finite game are games that we're all familiar with: basketball, football, chess, sets of rules, and your goal is to win. And then he theorized on the other side that there are a set of games called infinite games. In an infinite game, he says that there are no agreed upon rules. There's no rules to an infinite game, and it also never ends. So what does that mean, right? If there's no rules and it never ends, what is an infinite game? An infinite game is something where there are players in the game and there are dropouts, meaning you either have the resources to continue playing or you've lost the resources to continue playing and you've dropped out. And I think a prime example of an infinite game is running a business. There's no rules to starting a business. There's no end goal in sight, right? You can't win at running a business, but you can either be in business or out of business. And if you think about it, trading is very similar to that, right? There's no rules to trading, right? As long as you can buy and sell anything you want, there's no rules to it. And you either have enough capital to trade or you've blown up your account and you no longer have the resources to continue trading. So what you realize is that trading is not a finite game, but most investors still think of trading as a finite game. They think of them as wins and losses. And many times what we do is what the struggles that we have with trading and the reason that we are inconsistent in our trading is because we're trying to apply the rules of a finite game to an infinite game. And that's really where you have this frustration that comes in, because you keep trying to win and you keep trying to win at something that you can't possibly win. So what you realize is that when you're trading, when you're playing an infinite game, your goal is not to win. Your goal is to stay in the game. Your goal is to make sure that you don't drop out of, you don't go out of business, if you will. And that in the game of trading is making sure you don't blow up your account. You don't blow those huge holes in your portfolio. And I know that sounds easy to do, and the reality of it is that it actually is. But I understand that the question from many investors is, how do I go about doing that? And that's why we're going to show you the golden rule of trading. The golden rule of trading is really simple. It's trying to effectively trick your brain and trick your account into making sure you don't have any account blowups. So this is what we call the golden rule of risk management, which is very simple. You never risk more than 1% to 2% of your total portfolio on any single trade. We're going to go through some examples of this using some credit spreads, using some debit spreads, but the goal is to make sure that any trade that you make will never exceed more than 2% of your total account value. So even if the trade goes completely in the opposite direction that you expect it to, you're wiping out roughly 2% of your total portfolio value. And that means you still have 98% of your total account value intact, ready to play. So whenever I get an email from investors, and I get this unfortunately all the time, people tell me, a trade didn't go well and I've lost a lot of money. And that is a sentence that should never exist, because no single trade, no matter how bad it goes, right? You think a stock is going to go to 100, but it ends up going to 0. That trade should only cost you 2% of your total account value. And we're going to talk about why this is so important, why 1% to 2% is the golden rule of risk management. And we're going to discuss it very quickly, but it's going to become very apparent why you need to stick to these rules. But psychologically speaking, one of the reasons that you want to stick to these 1% to 2% rule is because smaller losses are simply easier to accept and let go of. Whenever you have, let's say, a $10,000 portfolio and you risk $1,000 on a single trade, it's going to be difficult emotionally to let go of that trade. You become what poker players call pot committed. You don't want to lose that money because it's such a large chunk of money, and you'll do whatever you can to protect that loss. You'll even throw more money at it to try to protect yourself from losing that $1,000. And unfortunately, again, in that pursuit of trying to prevent yourself from losing that $1,000, you open yourself potentially of opening up, risking even more money. And occasionally, even maybe half the time, you are able to recover from that trade. But the other half of the time, when you're not able to recover from that trade and that trade goes south, it only takes just once, for that to not work out and for you to blow up a huge hole in your portfolio, and you end up in the scenario that I showed you on that very first screen. So the golden rule of risk management is designed to prevent your account from blowing up in the first place, because that's your only goal when you're playing an infinite game. Think about it. The goal of trading is that over the long run, you're going to make thousands of trades. To focus your time and attention on a single winner or loser is just the wrong thing to focus on. Focus on the big picture, focus on the long-term longevity of your portfolio, not on single wins and losses. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. I know I've spent a lot of time talking about this, but I cannot express how important this is for the long-term longevity of your portfolio. And I'm just going to show you a few things to hopefully help solidify this idea, right? So the one thing that you also have to consider whenever we're trading is the fact that every single trade is really two parts: probability of success and risk to reward of that trade that you're making, right? Every trade you make has a potential risk, potential reward, and a probability of making that risk and making that reward. And the most important thing to remember whenever you're trading options is that, the most important thing to remember with any type of trading is that the higher the probability of success on a trade, the lower the risk to reward is going to be. And vice versa, a trade with very high risk reward is going to have very low probability. This is just a law of life. It has nothing to do with options or trading. It's just a law of life, right? Think about on one extreme, a lottery ticket, something that costs a couple of bucks that can potentially make you millions, very high risk reward. It's going to have very low probability of success. Vice versa, if you bet on the sure bet on the Super Bowl, you know, the team that's favored to win, guess what? If you do win, you're going to win less than what you put at risk, right? That's just a law of life. You can't get around it. And it's very important for investors when you're trading options to focus on both or look at the balance between the two, because I unfortunately see too many investors who will tell me, how do I find really high probability of profit trades? And what that tells me is that you're only focused on one thing. And when you focus on one thing and you don't look at the other thing, guess what? You're missing half the picture. And that's a recipe for disaster if you only focus on one thing. I see too many investors that have this belief that as long as you trade something with a high probability of profit, you'll make money in the long run. You forget that high probability of profit trades are risking substantially more than what you can potentially make. So the more important equation that you want to look at is what we call expected return. What you want to do is you want to weight the probability of success with the actual return of the strategy. So I have here, you know, what is a model of what typically a credit spread looks like roughly, right? So we talk about when we sell credit spreads, that we take losses at about a 100% of our max gain, and we take profits at about 50% of our max gain. So our worst outcome is usually twice as bad as our best potential outcome. And then when you weight this by the probability of each one happening, so a good credit spread usually should have 55 to 60% winners in this particular trade, and only about 25% of the time you have a full loss. And then you have a 20% chance of a small win. And what you do is you multiply the probability of each return and you add the three together. And what you get is an expected return. As long as your expected return is positive in the long run, you need to focus on the long run. And as long as you can continue this trade, you can expect positive returns in the long run. But what is the one thing that can derail all of this? It's when you make the decision of throwing good money after bad money, and you have one large loss that completely wipes this equation, turning it into a negative expected return. The goal is to have a positive expected return in the long run. And the steps to that is almost inconsequential, because when you're trading thousands of trades, having a few losers here, a few winners there, it's inconsequential. So let go of your losers as long as you're focused on the positive expected return in the long run. But again, the one thing that derails all of this is when you have those large losses, when you exceed your expected loss. And instead of losing 100%, you end up losing, let's say, 300% on just one trade because you insisted on trying to not be wrong and you wanted to roll a loser into another trade, hoping to make your money back. So does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of threes. Okay, I'm throwing a lot of new concepts at you. If this is new, that's okay. These are recorded so that you can go back and watch this at another time. So to go back to why this 2% rule is so important, we need to go back and understand a little bit about linear and exponential functions, because exponential functions is really the one thing that really creeps up on us, and it really bites us in the ass if we don't get it right, or if we don't figure it out correctly, or if it's not on the right side for us. And linear versus exponential functions, not everyone truly grasped this, I think, before COVID, but I think as a result of COVID, people kind of started to better understand it. Basically, when you have one case of COVID and you say, oh, that's no big deal, and then a week later you have two cases of COVID and you say, that's nothing. Next week you have 4 and you think to yourself, this is not really going to be a thing at all. And all of a sudden, next thing you know, you have 100,000, 200,000 million cases, right? That's how exponential functions work, is that at first it's so small, it seems like it's almost nothing until it's a little too late, right? And this is how, unfortunately, sometimes, the way your portfolio works. And it has to do with a few exponential functions that are very critical to the success of long-term returns in your portfolio. And someone said compounding returns, and that's exactly right. Well, guess what? Compounding returns works in your favor when, let's say, you're talking about a savings account in your that you have for a long time. But compounding returns also work against you with respect to losses, because the amount that's required to break even on a trade grows at an exponential pace depending on how much you lose of your portfolio. So when we say, losing 30% of your portfolio, you still have 70% of your portfolio intact. Well, guess what? When you lose 30% of your portfolio, you now need a 43% return just to get back to break even. And I would say that this chart really doesn't do much justice, in my opinion, because this bar looks so large that these bars actually look fairly small. But even a 30 to 40% loss gets to the point where it's almost impossible to get yourself back to break even. Once you blow that big hole in your portfolio, the chances of you getting yourself back to break even without depositing more capital is increasingly difficult. And the larger you are down this line, the more difficult it is to get yourself back to break even. So you think to yourself, oh, I lose 10%, not a big deal. Then you make another trade and you have another 10% loss, and the third trade that lose 30%. If you have 4 losing trades that lost 10% each, your chances of getting back to break even are almost zero without depositing more money. That's why whenever we're trading, we try to make sure that we stay on this side of the line. We never, ever at any point in our career have a total loss in our portfolio greater than 20%. Have you had extreme events that can cause a loss greater than 20%? Sure. But that might be something that you experience once in a decade or once every 20 to 25 years. The goal is to stay on this side of the line as much as possible, because if you're able to do so, guess what? If you stay on this side of the line, your chances of getting back to break even and continuing to grow your account is fairly high. Once you exceed this level, your chances of getting back to break even are almost impossible. Once you lose 50%, you have to gain 100% back just to get back to where you were. And then you want to grow from there. Guess what? That's going to be very difficult. Does that make sense? Please type 4 into the chat window if that makes sense to you. Perfect. And then the trick here is that compounding, this exponential function, also works in our favor with respect to how much of our portfolio we risk. For every 1% less we risk in our portfolio, the number of trades that we need to blow up our account grows at an exponential function. And guess what? You want to be here on this end of the curve. You want to make sure that it takes 50 to 100 trades. So you literally have to have 50 to 100 consecutive losses. Imagine having 50 consecutive losing trades. That's losing today, tomorrow, the next day, for basically 3 months straight, every single day before you've blown up your account. That's what it would take to blow up your total account value. If you risk 10% of your account per trade, then it only takes 10 trades to blow up your total account. It only takes 3 or 4 trades to get you into what I call the danger zone. And if you have 5 or 6 losing trades, it's nearly impossible to ever get back from those levels. So the goal here is to try to use exponential functions in your favor so that it takes an astronomically large number of losing trades before your portfolio blows up. Okay. Now, if you can utilize this rule, this is really where I see a lot of investors who, again, focus on the wrong thing, get tripped up. Because even when you have a large number of losers, so here's the same chart, same portfolio that I had before, but instead of taking that huge loss here, what I have is I have 1, 2, 3, 4, 5, 6, 7, 8, 9 losing trades in a row, right? But the 9 losing trades in a row that I took stayed within the 2% rule. But having 9 losing trades in a row, guess what? Yes, my portfolio took a hit, right, over that 9 losses, but I had most of my portfolio intact in order to continue trading. That is the difference between sticking to the rule and not sticking to the rule. And just to put that into context again, look at the difference between these 2 trades. A lot of investors think having 9 losing trades in a row is a death sentence. And I cannot express to you enough how much, if you stick to these rules, even if you have 9 losing trades in a row, you have most of your portfolio intact, ready to trade again, versus if you are just the type of trader who doesn't want to take a loss, and half the time you keep doubling down and you make your money back, but the other half of the time, and again, it only takes one trade that just because of bad luck, right? And whenever I showed this example of this, right, of trades, it's not necessarily because you're a bad trader, you're bad at reading the charts, you just can't get it right. It's just bad luck that you happen to have bought at the top and then kept trying to buy at just odd times and the stock just keeps dropping. It has nothing to do with your ability to trade. You just had bad luck. And guess what? Bad luck blows up portfolios. And what you need to make sure you do is that bad luck doesn't blow up your portfolio, that even a string of bad luck doesn't blow up your portfolio. So a lot of investors that have, and I can't express this enough, how many times I've seen investors that have 4 or 5 losing trades, and what they do is they give up on a strategy. They say, this is a terrible strategy. I'm going to move on to the next trade. I got to find a new service to subscribe to. I got to find a new indicator. I got to find a new option strategy. Don't do that, because 5, 6, 7, 9 consecutive losses in your portfolio is not going to derail your whole portfolio. What derails your portfolio is if you don't follow risk management. Am I clear on that? Please type 5 into the chat window if that makes sense to you. And anyone who says that, hey, I've lost this much on an entire trade, what that means is that you're not sticking to the 2% rule. Because if you stuck to the 2% rule, that loss would have been like this, and you would have continued on with your trading. But when we get stuck in not wanting to be wrong, right? And again, I completely understand the human emotion of why we don't want to be wrong, right? Because we made this pick. We personally picked this stock. We thought it was going to go higher, and it went against us. It screws with our ego. It screws with our perception of how we are able to read the charts or look at the fundamentals of a company. And you don't want to admit that you're wrong. But guess what? When you think about, and this chart here, this is a small series. This is only 40 trades. Over your lifetime, you're going to make hundreds, thousands of trades. Each individual trade is so inconsequential that trying to be right or wrong is really, it's not, dumb is not the right word, but it's really, just don't spend the time trying to look at individual wins and losses, because it's such a small factor in the grand scheme of this infinite game that you play. That's irrelevant. Exactly. Thank you, Gene. It's completely irrelevant to the long-term, goal of playing an infinite game. Wins and losses do not mean anything at the end of the day. It's how you grow your account over the long run that matters. Now, I understand that winning is still up because we're human, right? We want to win. And that's part of why I suggest for many investors who are trying to figure out a way to gain consistency in your trading is to use credit spreads, because credit spreads, you will win at least about 55 to 60% of the time just by selling credit spreads, right? Even if you're not very good at picking the direction on a stock, you'll still win about 55 to 60% of the time. So when you win more often than you lose, you're going to be able to gain a little bit more confidence in your trading. So it's the combination of using a higher probability of success strategy like a credit spread with the rules here of risk management that's going to help you truly gain that consistency in your trading. And what I'll do is I'll give you a quick view of how OptionsPlay helps you stick to these rules, okay? So regardless of how you arrive at a strategy that you want to trade, the OptionsPlay tool, when you click on the OptionsPlay score, and you just click on the OptionsPlay score, when you click on it, there's going to be a line here called max risk, right? So remember, let's go back to our spreadsheet here of how much you can risk per trade based on your account value. So let's say I have a $50,000, let's say I have a $50,000 account, which means that I can risk somewhere between $500 to $1,000 on a single trade. And this is really where you want to use the max risk aspect of this platform to help you make sure that you stay within that $500 to $100,000 risk on every single trade. And you don't want to just look at how much you're paying. You want to look at the max risk, right? Because if you're selling a credit spread, let's say you're selling a credit spread, and let's say I'm selling this particular credit spread. You're collecting $346 on that particular trade, but you're risking $1,054. So that's why it's important that you don't just look at the trade cost, you also look at the max risk, which is truly the number that you want to pay attention to. So regardless of how you arrive at your trades, you want to make sure you look at the max risk of a trade and make sure that that max risk does not exceed the limits for your account size. So if let's say you have a $50,000 account, your limit is $1,000. That means, you know, whenever I hear someone tell me your trade has lost a lot of money, that should never be a statement that you have to say, because no matter how bad a trade goes, you should never lose more than 2% of your total account value and feel comfortable with the fact that you have 98% of your account still left to trade to make the next trade. Is that clear? Please type 6 into the chat window if that makes sense to you. Okay, so I'm gonna give you an example here, right? I'm gonna look at the credit spread file and I'm gonna show you some trades and I wanna show you how you can apply this concept, right? So let's say I'm looking at BP. There's this 27.25 put spread. This is a relatively low price stock. So let's click on this BP put spread here. And let's take a look at the max risk on this BP put spread here. As you can see, the max risk is only $126. So for someone with $1,000 max risk, I can afford to trade quite a few contracts here. So let's look at our risk and investment calculator, which is the third dot at the bottom of your screen. And there's two options. You can say, I want to invest or I want to risk. And what you want to choose is I want to risk. And you want to type in the dollar amount that you can afford to risk. That means for my $1,000 in max risk, I can sell 7 contracts of this August 27.25 put spread. And that's going to put me at my max risk at $882, just underneath the $1,000 limit that I have for my portfolio. So the OptionsPlay platform does the work for you. All you have to do is type in the number that you're willing to risk based on the 2% rule, and that's going to be able to help you stick to that rule. Now I'm going to give you another example. Let's say you're looking at this report and you're interested in, let's see, there was Shopify on this. Shopify is a $1,400 stock. And I see this too often with investors, right? Is that they kind of just get into whatever trade they think is best. They don't really look at how much is the max risk and does it exceed my risk tolerances, because this max risk, as you can see, is $11,000, okay? Now, if my risk tolerance is $1,000, meaning the most I am willing to risk is $1,000, what should I do with this trade? Sometimes, and maybe the question is not always this extreme, right? Let me see if I can find a less extreme example, which I think some investors may find themselves more likely in. Let's look at Franco-Nevada. Let's look at this put spread. This put spread risks, let's see. This is okay. It's risk only $635. That's within my risk tolerance. So let's do this. Let's say I have a smaller account. Let's say I have a $20,000 account. So my limit is $400. That's the most I'm willing to risk on any single trade if I'm going to stick to the 2% rule. And I look at the credit spread file and I look at Franco-Nevada and I see that this contract risks $635. Now, I see a lot of investors, what they'll do is they'll say, well, you know what? That's the minimum that I can trade. So let me just go ahead and place one contract. The best rule here is that if the max risk of a trade exceeds what you can risk, the 2% rule for your portfolio, you should not be placing this trade at all. Because if this trade goes south, you're going to lose more than 2% of your total account value. Yes, there's some wiggle room in that rule, but when you have wiggle room in your rule, that's when you start to deviate away from discipline, right? Because ultimately, in the long run, in order to stay with the strategy, in order to have that positive expected return in the long run, it's about discipline. It's about understanding the rules that I've set in place with respect to credit spreads. What are the rules for getting in? What are the rules for setting your stop losses and getting out? And what are the rules around risk management? The more flexibility you give yourself on those rules, the more flexibility you're going to deviate from those rules, the more likely you're going to have chances where you can blow up your account. If you have these rules in place and you stick to them and they're black and white for you, guess what? You're never going to be in a position where you blow up an account because you follow these rules to a T. So I cannot express enough how important these things are for the long-term success for your portfolio. So, and because I understand how difficult it is, that's why we made it so easy. All you need to do is find your account value and make sure that you understand what is the range that you can risk in a total portfolio. And if you ever come across a trade that risks more than that amount, you cannot trade that amount. You cannot trade that at all. You got to trade something with lower risk. That's how you're going to be able to gain consistency in your portfolio. And as you slowly build your portfolio in value, that's when you're going to, as you build your portfolio into a larger and larger portfolio, not only from gains, but also depositing more money on a regular basis into your account. Let's say you deposit $500 in your account every single month and you have some gains to go along with it. That's going to grow your account. And eventually you're going to be able to trade that Franco-Nevada trade where you're risking $635. But that's because you've grown your account, not because you've bent the rules as far as how much you're willing to risk. So that covers what I wanted to share with you here today. And again, I cannot express how important this is for your trading. So just a quick summary of what we discussed here today. Remember, you're playing an infinite game. Focus on the big picture, not on the wins and losses. Get yourself out of the weeds. I see so many investors focus on individual wins and losses. They're somewhat inconsequential for the long run of your portfolio. So stop focusing on individual wins and losses. There's rules around when you take profits, when you take losses. It's not something that you need to have emotional ties to a trade. Just stick to the rules. It's either a trade that's at a take profit or a stop loss. And guess what? Sometimes you just have consecutive losses will happen. That's okay. Consecutive losses are not a death sentence. I cannot tell you enough how many times someone has sent me an angry email telling me that 3 trades in a row that I've told them about has ended with a loss or they're canceling their subscription. Well, guess what? If that's your view on trading, that 3 consecutive losses is something that's going to deter you from trading, you're going to run into that everywhere you go. From what strategy you go to, the next strategy you go to, at some point, you're going to have 3 consecutive losses. You're going to keep moving on. And guess what? You're never going to be able to gain that consistency. Learn a strategy and stick to it. Even if you have to ride out through 5, 6, 7, 8, 9 consecutive losses in a row, you're going to be able to ride that out if you stick to the 1 to 2% account value rule. Account blowups will basically end your trading career, which is why you want to avoid it at all costs. And like I said, it just takes one slip up to blow up your account. That's all it takes, you know, and I cannot express to you enough how much, you know, how hard it is sometimes to avoid it, but the rules in place are here so that hopefully helps you from avoiding that. And if you do want to manage roles, you know, a lot of people ask me about roles. Well, roll your winners. Don't roll your losers. Cut your losers. That's all you have to do. When you have a winner, you have a lot of options. You can roll a winner into a bigger winner, right? That's when you want to apply your roles. Stop applying your roles to losers, because that's when you can turn a small loser into a much bigger loser. That's when you deviate from your trading plan. That's how this all goes south. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to how you can shift your thinking from trading, because again, it's not a finite game. It's not about winners and losers. It's about the finite game, the infinite game, where you have to trade thousands of trades over the long run. So individual winners and losers are completely inconsequential. Get yourself out of those weeds and stop spending too much emotional time figuring out how do I turn my loser back into a winner, because the decisions you make in that space is usually what causes you to make bad decisions and cause you to potentially blow up your account. So with that, again, like I said, thank you so much for your time here today. I hope that this was helpful in giving you a better understanding of trading psychology and how you can shift your thinking. So with that, I do have just only today about 10 minutes of time to answer some questions. I unfortunately have to run, but I do want to spend some time trying to answer as many questions as I have time before I have to run. So with that, there's a Q&A window and a chat window at the bottom of your screen. If you could please type into your Q&A window, I will try to answer as many questions I have time for in the Q&A section. So let's see. Okay, with the 50% and 100% OCO, don't I need to do better than 80% of the time? No, with the 50% and 100% OCO, you have to be right 67% of the time to break even. But you're not taking into account the fact that you're going to hit your take profit far more often than the full max loss on a credit spread. But no, not 80% of the time. If you're a 25-75, I'm sorry, no, not even that. If you are a 20-80, then you have to be right 80% of the time. Samir, thank you so much. Lori, what about taking a higher risk trade but stopping out when it reaches your account's max risk? So Lori, this is a great question. The question Lori is asking is, why can't I risk 4% of my account per trade and then just stop myself out at half of that, right? So normally if I'm only willing to risk $1,000, why can't I risk $2,000 and then give myself that stop loss? Lori, in theory, you can, but stop losses do not guarantee execution, which means that the stock can gap open the next day, and when it closes one day, you're down $700. The next day it opens, you're down $1,500. So at that point, you've exceeded your max loss already. So you can, but there's a risk that you're going to exceed your max loss on the trade. Again, people always want to find ways around these rules and try to poke holes in these rules. And I cannot express to you enough, why do that? Why try to cheat the system? You know, it doesn't quite work in the long run. So who you're cheating is really yourself, right? You're trying to find ways to maximize return, but what you're really doing is you're increasing your risk. Do you ever use RSI overbought to close a winning trade? Frank, rarely. Usually I don't use indicators to be the sole reason that I get in and out of a trade. There's usually more behind a trade than just a single indicator of being overbought or oversold. Does the max 2% rule apply to trade costs or total value of the account? The 2% rule is the max risk of a trade relative to your total account value. On managing winners, rather than rolling a position, would it be advisable to exit at 50% profit, but perhaps 60 to 70% profit? So Brian, you can, many times, 50% is when you start to take profits. By the time you actually take profits, you might be actually up 60 to 70% on time. Most of our winners will actually take at almost 60 to 70% of the time, or 67% profit level. But yes, you can do that, but I'm saying that you can take 60 to 70% profit level and still roll your position into further profits, is what I'm trying to say. When should you close a debit spread? The rule of thumb for a debit spread is cut your losses at 50% loss and take profits at about 75% gain. Rolling a trade is very simple. Rolling a trade is just closing an existing trade and opening a brand new one in a single trade. That's it. You're just placing both trades at the same time. Will this be posted on the website for viewing again? Yes, all of our videos are posted on YouTube for replay. So placing OCO orders will take care of risk. Placing OCO orders kind of take care of risk because, again, the market can blow through your stops and you can get stopped out worse than what you were expecting to get stopped out at. So you really need to make sure that you understand the difference between those two. Is the cash secured put report available as a proper spreadsheet so I can sort the rows? Graham, that is something that we actually just finished. So we will be launching that very soon because the credit spreads, you can now sort and filter. We're going to be doing the same thing here, how you can sort and filter on the credit spreads. We're going to launch the same thing here for cover calls and short puts as well. William, thank you so much. I have 3 separate portfolios. Do I risk 1% of one portfolio or the sum of 3? David, I guess that depends on which portfolios you speculate with. I would say that you have to take what percentage of your portfolio do you do your speculation with, right? So if you have 2 of those portfolios that are long-term retirement accounts and you're not actively trading in them, then those are excluded from, the portfolio sum, if you will. How hard is it to trade at the $5,000 account and keep it to the 1 to 2% rule? It's difficult because a $5,000 account means that you cannot risk more than $100. I tend to find that at this extreme value, many traders have to find themselves in that 3 to 4% rule. Now, 3 to 4% rule is not the end of the world. It's more risk than I think most investors should trade. But I understand that when you have a small account, there's only so far lower you can go. So I do find that sometimes with a $5,000 account, investors do have to step into the 3 to 4% range in order to even find trades to make. Can you explain how the unwinding of a large put position fuels share put price higher? Andrew, I'll try to address that in our market making class because that kind of has to do with how market makers hedge how they hedge their risk on a trade. That's going to help us better understand that. So I'm going to answer that under when we do the course on market making. Before cutting a losing spread, why not sell the other spread, other side of the trade to collect more premium to reduce the loss? So again, Kenneth is suggesting a way to potentially gain a little bit, a slightly higher edge. So Kenneth, what I'll say is that yes, in that position, you can potentially reduce the loss a little, but you can also increase the risk on that as well. So, you're increasing your potential returns, but at the same time, you're increasing your risk. And yes, you can do that, but in the long run, that's not going to net you some big, significant change to your strategy, in my opinion. So with that covers what I have time for you here today. Unfortunately, I have to run, but I want to thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a jump start into how you should think about your trading and your psychology. And hopefully this gives you some insights into how you can gain some more consistency in your trading. With that, thank you so much. I'll see you guys tomorrow morning on our next thematic investment series. Have a great evening.